Liberty Nation with Tim Donner.
Well, the emotional challenge for each of us in this not-so-brave new world which envelops us these days is to avoid getting depressed or fearful in your isolation or because of your job, which is now in jeopardy or not even there anymore, but also to avoid being uplifted with false hope or pie-in-the-sky best-case scenarios. Things might turn out for the best, but we can hardly count on it, at least not yet. Now, of the many 180-degree changes we're all trying to process as we view the world circa late March 2020, arguably the most frightening is to an economy and stock market, world markets, hit by a thunderbolt which jolted them from robust growth to recession in a matter of days. Joining us to help make sense of what's already felt like a long, strange trip with miles to go before we sleep, to seamlessly segue from the Grateful Dead to Robert Frost, is LibertyNation.com economics correspondent Andrew Moran. Hello, Andrew.
Hello, sir. Thank you for having me.
It's a pleasure. Which would you choose, Grateful Dead or Robert Frost?
I'm going to say whoever has the most supply of razor blades.
I'll let our individual listeners parse that statement for themselves. So, Andrew, let's start with a dramatic understatement. Things are very different than the last time you joined us when we were discussing the almost esoteric question of whether 2% or 3% economic growth was realistic for 2020. Now, we're told that we're looking at the live possibility of a complete global economic collapse. So let's start with something that some might consider crude, but I think just might hit to the heart of the matter. Looking at the hysterical sell-off on Wall Street, it strikes me as very similar to the run on bathroom tissue at stores all across the country in terms of the behavioral instincts of a people in panic. Is that an apt analogy for the market?
Yeah, yes, I think it is an apt analogy. And, we tend to make fun of people who are stockpiling toilet paper or in the financial markets, people selling everything they have. But you can't necessarily blame them because there's so much chaos out there. There's so much uncertainty. No one knows what the heck is going on. Anything can happen. Although I haven't seen the data to support this, but I think the main sell-off that you mentioned earlier had to do with the mom and pop investors. These were people who they put all their money into the late stage of the bull market, and they couldn't bear the bear market.
Sure, I mean I was among those that panic sold in 2008, and I don't really regret it. Although hindsight is always 20/20. Nevertheless, Andrew, won't the fact that we're in a truly global economy make our U.S. recovery from this so much harder because we can't control what happens with our dozens of trading partners whose economies will likely all go into recession of one kind or another? And how well positioned would the U.S. be compared to EU nations and the rest of the world if there is indeed a steep global recession?
Well, I think the European Union, they already used a lot of their stimulus programs. Just this week, they announced more bond buying on top of the quantitative easing they were doing before. So they already had all these Keynesian QE interventions, even during the boom phase. When it comes to the Federal Reserve, the main problem is that, yes, they will probably rescue the economy right now, and because they fired off all their bazookas, $1.5 trillion in repos, and then the 0% interest rates. They've thrown everything but the kitchen sink at this crisis. But the main problem with right now is that during when there is the next economic collapse and there's the next recession, the Fed will be out of bullets. They use absolutely everything. Perhaps the only thing they could use now would be sub-zero interest rates. And some Fed members have said we are not considering negative interest rates, even though if nothing happens in the market, if nothing survives and the coronavirus lingers, that may be the only thing they have left.
Now, the federal government does have more bullets to fire. They can spend a whole lot of money, and they're already planning to spend more than $1 trillion of it to prop up the economy. So, Andrew, too much, too little, just right?
Well, I know maybe a lot of people give me slack for this, but when you consider the current finances of the United States, $1.2 trillion is a lot of money when you consider a government that's already running $1 trillion deficit, a $23 trillion national debt, $500 billion in annual debt servicing payments. So perhaps this would have not been such a big price tag if Trump had actually been fiscally conservative during the days of wine and roses instead of just adding to the debt and then hopefully get bailed out by the private sector, which right now is what actually is happening. Trump will probably continue to get bailed out because there's such a huge appetite for treasuries right now. You saw this just last week when the benchmark 10-year note fell to a record low of 0.318%. That's the lowest it's ever been. And then you have the Fed, who's also bailing out the White House by monetizing the debt. And then the other problem you have is if Trump fails to win in November and Joe Biden wins, then you have America's finances will be probably a lot worse because of all of his multi-trillion-dollar promises that he only paid for with Fed easing, with more borrowing, and with hopefully more private sector bailouts on the bond market.
Now, we don't want to be all doom and gloom here, so let's talk about our eventual recovery from this nightmare, which feels like it's going on is still at about 3 a.m., still far from the waking hour, should we say. A lot of economists are discussing a so-called V-shaped recovery, fast down, fast back up. Is that a valid forecast based on what we know right now, understanding there's so much still to come?
Well, the main problem with the market right now is that even everything that's been thrown at it, with the Fed easing and the government bailouts and all the other governments around the world and central banks doing the same thing, is that nothing seems to be improving. The main thing is that the coronavirus, as long as it stays, as long as it keeps infecting people, you're going to continue having these dead cat bounces. You're going to have investors trying to catch falling knives. You're going to have these volatile 1,000-point swings. When President Trump said a week ago that when this whole thing subsides and the market's going to boom, he was right. There's so many opportunities right now, and everything's going to return to normal. And you have Fed easing and pumping money into it, and then it's a year afterwards you have to worry about when the bust happens. But overall, everything's going to return to normal. People shouldn't be panicking as much. You're going to get your toilet paper. You're going to get your avocados. We're all going to be good to go.
That's what we were waiting to hear. Thank you for joining us, Andrew. I appreciate it.